Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kiryll Prakapenka and Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
We covered plenty of fascinating stuff this week. First, we discussed how recent profit downgrades suggest an ASX market correction is imminent. And then we mentioned how forward orders are signaling slowdown in business conditions and how one prominent magazine cover is a contrarian indicator that an inflation peak is already priced in. Greg then explained why the stock market usually rises during a rate hiking cycle and when the market falls. And we finished off with a nerdy equation, which explains why US stocks are still on a bullish run despite everything. Hello, and welcome back to the 5th episode of What's Not Priced In. Greg, welcome. And can you believe it's already been, 5 episodes, 5 weeks worth of
5 weeks.
podcasting?
There you go. No, time flies when you're having fun, Kiryll.
Exactly. Now, it's been 5 weeks, and over those 5 weeks, I do sometimes like to start off the podcast with an interesting quote that sort of summarizes the spirit of the show. And I have found another one, and I thought I'd indulge myself and quickly share it with you. It's quite an old quote. It's from 1976. It's from the Financial Analyst journal. It's
I like
quite a
old
good
quotes.
journal, actually.
Stand the test of time.
Yeah. Yep. So it was from the then editor, Jack Trainer. He was the editor of the Financial Analyst journal, and he had this great quote that I want to share, and I think it sort of goes to the heart of what we try to do here. And this is what he said. He said, "There are only two kinds of investment ideas. Those whose implications are straightforward and obvious, take relatively little special expertise to evaluate, and consequently travel quickly, like hot stocks. And then there are those ideas that require reflection, judgment, special expertise, etc. for their evaluation, and consequently travel slowly. Pursuit of the second kind of idea, rather than the obvious, hence quickly discounted one, is the only meaningful definition for long-term investing." And I thought that was quite a great quote and encapsulates what we try to do here.
Excellent quote.
Yeah.
And it's a good way to think about investing is also a reflection of your personality and your the way that you interpret events in the world. And look, there's some people that love a hot stock and love a hot trend, and there's nothing wrong with that. As long as you understand what the risks are and how to play those trends really quickly, and you can be in and out. I've never been very good at that, and I've always been really cautious about being involved in that style of investing just because it doesn't suit my personality style. I like to do good analysis beforehand. I like to make sure that when I'm buying something, I know that what the value is that I'm buying, and I like to know that I'm buying at a discount to that value. So if there is certain events in the market, certain shifts in sentiment, that I can have a bit of an anchor to know what it is that I'm owning and those sorts of things. Whereas when you invest in hot stocks, and whether that's lithium, whether that's AI, whether that's whatever the flavor of the moment is, you have to be really either ignorant of those things and therefore just ride the trend, and if you're lucky, you can get out with a profit, or you can have to be really switched on as to what those shifts in sentiment are and to be able to take advantage of them. And I was looking through some charts just before we started this show, and there's a company out there called Lake Resources, and I know it because I got put into a thread on Twitter maybe a year ago where I kept getting copied into these people ramping this Lake Resources, and I just kept ignoring it. But it went up hugely, and I think it was a favorite of a lot of people on Twitter. I don't even know the stock. It probably has something to do with lithium being Lake Resources.
Yeah, so, it was a lithium stock.
But it has completely bombed over the past 12 months, and it is now falling quite sharply and hitting new, multi-month lows or 12-month lows. So it just goes to show those types of stocks, you're in there for a very short time. You try to get a ramp, and you try to make a decent amount of money, and then you're out of there. But to me, that's just low probability investing. Whereas what we try to do is have a strategy that you can replicate over and over and over. And one of those the key part of that strategy is to keep asking, what is the market missing? What has the market priced in, and has that been more than reflected in the price? Is there good value? Do the charts show that the downtrend has stopped and there might be a shift in that trend to higher prices in the months ahead? And if you tick those boxes, you've got a pretty good return. And not to sort of talk about my stuff here, but I've recently updated my performance since I started doing this back in 2014 and recording the performance. And the average pick in my service has outperformed the market considerably in that time. Now, some years I outperform, some years I underperform, but over time, using that process, you're gonna do well. And going back to your original quote, you need patience to do it, because sometimes you feel like it's not working, the market's not on your side, and there is a temptation to jump and do something differently. But if you are patient and you can replicate that, and your personality is wired to that way, it's a good way to invest.
Yeah, definitely. It's good that you mentioned Lake Resources. I think for a while there, I think in 2021 it was one of the top performing stocks on all odds, and I think most of those stocks that were the best were lithium stocks, and then it just goes to show that a lot of that was already discounted, and then now the stock is down way from its
Which is why we
all-time
look for the top
But-
underperforming stocks of the
Exactly.
of the year to see where the opportunities might be for the next 12 months. Doesn't always work out like that, but you're going to have a more chance of making money in the next 12 months than trying to follow the last 12 months best performer. It happens all the time.
Yeah. Regression to the mean. Well, with that said, I think we'll turn to some of the stories of the week and maybe a bit of a review in what the market is pricing in and what it sort of isn't. So where would you like to start? What's the biggest story that you've sort of been following this week?
I guess the biggest story is
because we do have quite a lot to cover.
The shift in market sentiment, which we saw abruptly yesterday. The ASX 200 fell over 1.5%. Large part of those 200 stocks were down. I think from memory, there was only 20 stocks that finished in the green yesterday. So there was broad selling, and it wasn't necessarily because of the US. So the US is still in pretty good shape in terms of the sentiment over there. There has been a bit of profit taking over the past few days. We're recording this on Friday morning, 23rd of June. So overnight in the US, on Thursday, markets were up again. But our market really cracked yesterday, and there was a lot of selling. No real catalyst for it. My only assumption is that investors are starting to wake up to the fact, and we've been talking about this on the podcast for the last 5 weeks, is that the lagged impact of monetary policy will flow through and have an impact. So, I think that's the biggest story. This shift in the market. The last sort of rally over the previous 10 days didn't make a lot of sense to me. I sent out, I don't really tweet too often, but I sent out a tweet on Tuesday afternoon saying, can anyone explain this rally? I said, it just seemed bonkers. I don't understand it. Most of the people agreed and said, no idea why. There was a few people that gave reasons as to what that might be. End of financial year, buying by fund managers, all that sort of stuff. But really, it didn't make a lot of sense given the headwinds that we are facing. And we talked about the retailers last week. The retailers are under huge amount of stress. We talked about the mortgage cliff. So all those things just seem to be coming into view. I do want to show some charts just to give people a bit of a sense of where the ASX 200, where the various indices in the Aussie market are sitting in at the moment. So in the scheme of things, got the ASX 200 here. In the scheme of things, the fall yesterday took off quite a few days of rally previously, but it doesn't really do a hell of a lot of damage from a charting perspective. So if you're a chartist, you probably look at that and say, look, it's a bit worrying to have such a big fall, but these medium-term trends here, this medium-term trend, which is the 50 and 100-day moving average, still seems reasonably holding up reasonably well. But the point is that the ASX 200 is not hugely far from its all-time highs, which it's tried to beat a couple of times over the past couple of years, but hasn't been able to break through there. But then when I look at the sub indices as well, so this is the ASX 200 banks index, that probably looks the worst out of many of these indices. So banks have sort of gone sideways for the best part of 2 years. Tried to break through old highs back in February, turned down from there and turned down rather sharply. And each time it's rallied back up into these moving averages, it's hit selling pressure, and the same thing has happened here again. So if I look at the banks, they've had a nice little rally out of a breaking of support, come up and hit this resistance again. So this downtrend seems pretty intact for the banks. And we talked about the banks in one of the episodes and talked about the overvaluation of the key bank, Commonwealth. The other banks seem like reasonable value, but given that Combank is the leader in that sector, the fact that that is still significantly overvalued in my view, and the way I look at valuations suggests that there's more downside for the banks to come, and that's given that we are going to see continued pressure on the market because the RBA is going to keep rates high. As I said, I think it was last week, I think the RBA is probably a lot closer to being on hold now than what the market thinks. I know there's a lot of talk out there about continued rate increases. Not sure if that's going to play out. I have more to say in that in a minute, but we'll just run through the rest of these indices just to give people a sense of where the Aussie market's at. The resources index really close to not far from all-time highs that were reached in January this year. So we did have a correction, rally back up. To me, this could be turning into a downtrend as well, and that's on the back of weakness in iron ore. Energy looks like it's holding in there reasonably well. So even though you've seen a 50% retracement in oil prices over the past 12 to 18 months, the energy stocks have really held in there, which is, to me, sign of longer-term structural support. I'm bullish longer term on energy stocks. Consumer discretionary, this index seems to have rolled over. It looked like it was trying to break out to new highs here. As recently as May, it was up to nearly breaking out to new highs for this move, since really sharply turned down, and yesterday was another heavy selling day. The small ords, this index has really struggled, hasn't rebounded in the way that many of the other indices has, and that's just a reflection of small companies really struggling in this economic environment. The utility is doing really well on the back of AGL and Origin, which is under takeover offer. So those are the two key stocks holding this index up. And if you look at the industrials, which is a big section of the Aussie market, that's a really strong looking chart. Recently broke out into new highs and holding above those highs. So in terms of the economic situation, the industrials are shrugging that off. So it'll be really interesting to see here whether they can hold above this level or whether it falls back down in below this support resistance area. And lastly, just the consumer staples, which is really your Coles, your Metcash and Woolies. Not really terribly exciting, but that's the industry, quite defensive. So that can imagine that it would attract a few capital flows in this environment. And just on the market situation, going back to the US is still in extreme greed mode. We showed this last week. It's actually not too dissimilar to what it was a week ago. It was 82 points a week ago. Now it's 80 points. So it's still in the extreme greed. The volatility indices are showing that there's just not a lot of concern out there. This is, we showed the MOVE index last year, which is an index of bond market volatility. That's coming down. Euro-dollar 1 month option volatility, very, very low. And just the VIX, which is the standard, standard indicator of share market volatility, very, very low as well. So there's no real concern happening in US markets or overseas markets, but the Aussie market is starting to get a little bit wobbly. And one of the key charts that might indicate why, this is from the NAB business survey that was out a couple of weeks ago, and it shows forward orders leading business conditions. So forward orders are starting to fall quite sharply, and they tend to lead business conditions by a couple of months. So I guess my conclusion would be
and I
that
think
the market is starting to see a slowing Aussie economy, and share prices are starting to adjust to that. So yeah, I mean, I think that pretty
and I
much
think
explains things.
yeah, definitely. I think with that NAB survey with the forward orders, the report did say that historically there have been very few periods of negative orders outside of downturns in the economy. So that's a pretty blunt message of what's to come. And I think definitely I think there was another chart that the report from NAB had that I think forward orders have been especially hit in the retail sector. And I think one of the biggest stories this week has definitely been the horrible downgrade in profit from Best and Less. I think a huge cut in profit guidance, and it was only I think in May that the company said, "Look, things are looking a little bit uncertain," and they set guidance, and then I think this week they said, "Well, sales have actually deteriorated sharper than we thought, and we've actually had to cut our profit guidance because they're continuing to promote and continuing to discount, and so that's definitely hurting their margins. And sales are down, I think, over 10% on a like for like basis. So if a retailer like Best and Less is struggling, it's definitely a big concern for other retailers.
Yeah, it was a really sharp profit downgrade, and thankfully they're under takeover offer, so the share price didn't reflect what that downgrade was. But it's just symptomatic of what's happening in the sector as a whole. During the week, UBS came out with a downgrade of profit expectations for the whole sector. I do think this is getting to a point where it's getting interesting for retailers. We've spoken about this before. When you see negativity around sectors like this, it's time to get interested. And I think the next step for me will be looking at what the profit downgrades are. You want to see probably 2 or 3 rounds of profit downgrades before you can say, okay, maybe earnings are based, because the difficulty with retailers is over the past couple of years, they've had maybe better than expected earnings purely because there was the lockdowns, there was the giveaway of money, governments paying people to stay at home, not work and consume. And certain retailers did very, very well from that. So you could probably look at 21, 22 earnings as being outliers. The difficulty is trying to work out what is the trend growth and what is a reasonable earnings base to then start to say, okay, what are the PEs, what is the profitability based on these, and I think there does need to be a certain amount of rebasing of those profit expectations. So you can't necessarily compare them to 2022 and say, oh, profits are down 30%, therefore this must be a good buy. You probably need to go back and look a couple of years, 2018, 2019, and work out from there whether the downturn in expectations is getting to a point where these companies are a good value. And as I said in previous weeks, I think that's definitely going to be the case. I think we will see really good value unfolding in the sector, but you just need to be patient, because with the RBA keeping rates on hold, at least, even if they don't raise rates again, I think you're going to see rates on hold for some time. And we pointed out that mortgage cliff last week with 60 bill worth of fixed rate mortgages coming off in the next quarter. There's going to be continued pain in the retail sector, so you just need to be patient. And this is where the charts can come into it and show you whether the downtrend has stopped and whether there's buying support coming in before you start to try to catch that proverbial falling knife.
Yep. And I think speaking of the retail sector and maybe retail stocks, I did find a very interesting quote from the RBA Deputy Governor, I think Michelle Bullock. She gave a speech about employment or unemployment, I think, a few days ago. But I think during that speech, she did mention something that was very interesting. She called it the $1 million question. And that question related to the outside savings that Australians built up during the pandemic due to all the stimulus and us being pent up at home. And I think it was a bit of an unprecedented situation where I don't think a lot of economists or politicians thought that we would accrue so much savings. And actually, our savings buffers ballooned. And what she said was that during the pandemic, Australians, on average, not all households, but on average, built up massive buffer of savings. They couldn't spend it. They spent what they could on goods, and then they couldn't spend anything on going out or going on holiday. So they just saved it all. And the $1 million question is, what do they do with it? Do they continue spend it? Or do they decide, well, no, I'll sit on that now and I'll just use it as a bit of a buffer for the future? So I think that is a great question, especially for the consumer discretionary sector. If there is still excess savings that the average consumer has, do they continue spending it, or do they sense now that the market is sort of maybe turning, economic conditions are toughening, and will they now decide to sort of take that money out of the market? I think that is the $1 million
Yeah,
question.
absolutely.
Probably $1 billion
And
question.
I don't know the answer to it. I do know that when we covered the GDP national accounts a couple of weeks ago, can't remember what you said exactly, but I think the saving rate was down to a level it hasn't been for many years.
Yeah.
So we have already dug into those savings considerably. And when you look at the rate rises that are coming through and the ongoing increases in interest payments that people are going to have to put towards higher mortgage costs, there's a argument to say that those savings will continue to be run down purely to keep people's heads above water. So I'm not sure. Look, I think the easy answer is that the majority of those savings have already been spent into the economy in terms of creating better than expected growth. And from now on, it's going to be really hard to do that. And the national accounts from December to March showed that we are nearly in recessionary conditions, and on a per capita basis, I think the economy went backwards in that quarter. So things are already slowing down quite a bit. More interest rate rises coming through the system. I'm not quite sure whether there's enough savings there to continue to spend our way out of this.
Mm-hmm. Yeah, definitely. Well, speaking of interest rates, I think you found an interesting magazine indicator from The Economist. And maybe you could share with the
definitely.
audience.
And the reason I thought this was so this is The Economist magazine. The most recent cover is called "The Trouble with Sticky Inflation." And the reason I thought this was interesting, because we've spoken previously about interest rate rises, and my view is that the Fed is probably a lot closer to being done with interest rate rises, and the RBA as well. And when you get a magazine indicator like this that basically says what everyone's been saying for the past 6 months, inflation's sticky, what are we going to do about it? To me, it's almost like a classic contrarian indicator of worrying about what has been and not necessarily focusing on what's coming. And so this in many ways just cements my view that we are probably a lot closer to the peak in interest rates than what a lot of people are expecting. And I know there's a lot of commentary in Australia about the Reserve Bank's potentially going to raise its cash rate to above 5%, which would entail another 3, maybe 4 interest rate rises from here. And I could be completely wrong, but I don't see that happening. And for those who don't know, we like to look at magazine indicators as a contrarian indicator purely because they reflect what the market's thinking and they reflect what news is already out there. And obviously one of our key sayings is, if it's in the news, it's in the price. And I think certainly the way that the market is looking at interest rates, and look, to be fair, the Bank of England just raised rates overnight, and they definitely do seem to have a sticky inflation problem. So I'm not saying it's not there. I'm just saying if we look ahead 3 to 4 months, the environment could be completely different, given that there's a lot more rate rises in the system still to flow through. And I've got to interesting chart in a little bit with a comment from a really good economist that I follow that we'll dig into on the what's not priced in section.
Yeah, and well, would you want to turn to that now, or did you want to cover anything else that you found during the week?
Why don't we turn to it now, purely because it's on the topic, and I think
Yep.
I think it's a really, really interesting take on the whole interest rate rise aspect. Now, I'm going to read from economist Dave Rosenberg. I've been following Dave probably for the better part of, probably since 2007 when he was in Merrill Lynch, and then he went to Gluskin Sheff, which was a Canadian company or fund manager. Then he went out on his own and now does Rosenberg Research. And I just like him because he is a contrarian guy as well. He's bullish when when you deserve to be bullish, and he's bearish when he sees certain things to be bearish. So he doesn't go with the crowd at all. He's not influenced by mainstream opinion, and he's very, very thorough on his research. So let me just read from a research note that he put out this week. It is quite long, so I apologize for the chunky quote, but I think it's really important, and I think you'll get a lot out of it. So this is what he said. There is so much talk about how the stock market has weathered the Fed tightening program with tremendous panache. But as I have kept saying, being a keen student of economic and financial history, this is nothing new. With just one exception over the past 6 decades, the S&P 500 actually was higher at the date of the last Fed rate hike than at the time of the first volley. This is because most of the time the Fed is raising rates, and this does compress the market multiple, but it does so into a rising corporate earnings environment, which acts as a strong antidote. So depending on whether the May rate hike was the last this cycle, or whether the Fed does lift rates once again or twice more, the S&P 500 is little changed from where it was at the time of the first rate increase in March 2022. As everyone celebrates this accomplishment, let me assure you that 90% of the time in the past, the stock market has been higher from point to point in the Fed tightening cycle. In fact, the average gain is plus 14% and the median closer to 15%. So what he's saying there is that during the tightening cycle, 90% of the time, on average, the S&P 500 actually finishes higher. And that's because the tightening cycle coincides with rising strong economic growth, rising corporate profits. And those rising corporate profits more than offset the compression effect from a rising interest rate / market rates, discount rate, the equity risk-free rate, all those sorts of things. So what has happened is not really been unusual for the market to rise during a Fed tightening cycle. And in this case, it's completely flat. So I'll continue with the quote. So being roughly flat this time around is hardly a major feat. The only other time historically when the stock market was this weak in a Fed tightening cycle was back in the 72-73 phase. And guess what? The S&P 500 was down 35% in the next year and still in the hole, minus 20% 2 years hence. The key, as always, are the lags. The market rallied 8% in the August 1980 to December 1980 aggressive tightening period, and then look what happened to the S&P 500 next, right into the August 1982 lows. During the 2004 to 2006 tightening ahead of the GFC that nobody saw coming, the S&P 500 advanced 11%. Did you really want to extrapolate that performance into the future? In the 1999-2000 Fed tightening phase, as the tech bubble got going, the market rose 7%. But what happened the year after the last tightening? Tried down 10%, and 2 years later, down 14%, and the bottom wasn't turned in until after the fall of 2002, or autumn of 2002. So, and this is the really important bit. So the point is this. There is nothing strange about the stock market withstanding the Fed tightening cycle. It happens almost all of the time. All the bad stuff happens after the last hike, as all the lags from the prior tightening cycle kick into the economy and earnings kick into the economy and hurt earnings, and we have yet to see that chapter written. So I guess that's self-explanatory, but what it's really saying is that once the tightening cycle is ended, then you sit and wait for all the momentum of that tightening cycle to wash through the economy, or in other words, you wait for the lags to hit. And if you want a visual representation of that, I've got a chart that shows this is the 2000 to 2002 bear market. So this is back when we had the last tech bubble. Obviously from 99, 2000 was a well-known bull market in tech. The Fed started raising rates and it went on hold for the better part of 6 to 12 months. And then I've marked in this chart where the Fed started its aggressive easing cycle. So this is okay. So this chart shows the S&P 500 from roughly 1998 through to 2003, and you can see the rise there. The Fed went on hold. I think it was in about 2000. Stayed on hold for a little while. And then in early 2001, when it was apparent that its rising cycle had created an economic slowdown, it started to ease aggressively. Now, during that easing cycle, the S&P 500 fell 43%. Now, that doesn't necessarily happen like that all the time, but it just reinforces Dave Rosenberg's point that the lagged effect of monetary policy takes some time to work its way through. And by the time the Fed goes on hold, it's already done enough tightening. And it goes back to my view that I think the Fed and the RBA, for that matter, has done enough tightening. It's just the market hasn't really seen the evidence of that yet, because the lagged impact of monetary policy is unknown. A lot of people don't factor it in. And it's only when the profit warnings start to flow through that you get to a point where you think, okay, well, things are starting to slow down. And just this week, we saw quite a few profit warnings flowing through. You mentioned Best and Less before. Fletcher Building came out with another profit downgrade. Interestingly, though, its share price held up well, which suggests that a lot of that bad news is already priced in for Fletcher. So that's an interesting angle there. What other companies? There was, I think it was IDP Education.
Yep.
And I can't remember what else, but there's been a few profit warnings this week. And as we get into the end of the financial year, we could see another, a few more in next week.
Oh yes, it was Rex Airlines was another
Rex
one.
Airlines. Now, whether that has to do with supply constraints of being able to get crew and all that sort of stuff, I haven't looked into the detail of that. But I did note as well in the week that we just had that Qantas finished down, Webjet finished down, Flight Centre fell quite sharply yesterday or the day before, I think it was, on its investor presentation. Corporate travel management broke down on the charts. So there's a lot of, we've spoken this before, is the reopening theme starting to wane? And I think that's true now as people start to, going back to the spend. They spent their excess, and now it's time to probably pull their heads in a bit. And I think you're just seeing that in the charts of lots of different stocks out there.
Yeah, well, yeah, definitely. Because I think travel, if you're traveling for leisure, it's probably one of the most discretionary purchases you can make. And if people are worried about their savings or worried about their jobs, that's probably one of the first purchases or plans that you're going to defer for the future. And I think there was one, we were having a conversation, I think a few weeks back, about this thing called the RV indicator, the recreational vehicles indicator. And I think, especially in the US, it's been flashing some recessionary signals because it's also one of the most discretionary purchases you can make, because you have to borrow money to buy those vehicles, and you're only ever going to buy it if you can afford it. And clearly now people are maybe starting to worry about their budgets, and also borrowing costs are rising. So that's one thing.
Actually, there was another indicator that I think also, that I saw
yep.
On Twitter today. It was the cardboard box indicator. And I thought that was quite interesting, that the rationale is that you get everything delivered in a cardboard box these days. And if cardboard box prices are starting to fall, then that's an indication of slower activity, slower purchasing, less deliveries, all those sorts of things. So there is anecdotal evidence of that happening. There is another chart I wanted.
And I think Fed Express also issued like a pretty bad quarter, or it didn't meet expectations. So that's something that to corroborate.
Sorry, that was FedEx in the US,
theory.
you mean? Yeah.
Yeah.
There's another chart just on that theme that I wanted to show you. Now, this shows the bank credit growth of all commercial banks in the US, and goes back to all the way back to the 70s, right? So each time there's a recession, the recessions are the shaded bits. Each time there's a recession, you see a sharp fall in the bank credit growth. So not necessarily below zero, but just a sharp fall from high growth to lower growth. And that happens in every shaded period that you see here, except really this short one in 2020. But there was a little dip just before that. But obviously that was completely unrelated to what was COVID related. But if you look at it here, we've gone from 10% growth down to nearly zero growth on a year-on-year basis. Now, that is one of the sharpest falls outside of 2008, or the 2008 to 2010 period, really. It's one of the sharpest falls in the whole history of this series, and we don't have a shaded period yet. So I think it just shows that the US economy, going back to what we said before, the lagged impact of monetary policy is starting to bite. Bank credit growth is slowing sharply. And the question most people would have is, well, why isn't the stock market reflecting that? And I think the important thing to understand is the stock market, sometimes it's not always about forward looking and seeing where the economy is heading. A lot of the time it's liquidity based. And you got to remember that the Fed doubled its balance sheet in 2020 to ward off the impacts of COVID. And then the federal government created massive stimulus that in many respects is still flowing throughout the economy and is therefore not reflected in these bank credit statistics. People don't need to borrow if they've been given money by the government. But there's a little liquidity equation that I wanted to show as well that in many ways explains why the S&P 500 does things that sometimes doesn't make sense. So net liquidity in the US.
I'm excited for this. I said I'm just excited for this. This is
but you're a nerd,
segment.
so maybe it's not going to be as exciting. Maybe it's not going to be as exciting as we're making out. But I take your point.
No, this is riveting.
It is riveting. It's riveting for people like you and me, Kiryll. So net liquidity is the size of the Fed's balance sheet minus the TGA balance, which is the Treasury General Account, minus the reverse repo balance. Now, before you go to sleep, let me explain what that means. So the size of the Fed's balance sheet is really just the credit that the Federal Reserve puts into the economy. So when it buys assets, when it buys government bonds, it increases the size of its balance sheet. Now, as you know, the Fed has been doing QT for the best part of 12 months, which means it's been shrinking its balance sheet by about $90 billion a month. Now, a lot of people think, okay, the Fed's doing QT, the Fed's raising interest rates, surely liquidity is shrinking, surely that means the S&P 500 should be going down. But that doesn't always work like that, because you've also got the TGA balance, which is the Treasury General Account, and that is a product of the government issuing, or the Treasury issuing bonds and taking money out of the economy and putting those bonds into a special account at the Fed called the Treasury General Account. So when that account is growing, that's actually taking liquidity out of the system. And when that account is falling in value, it's putting liquidity back into the system. And then you've got the reverse repo balance. So the reverse repo account was created a number of years ago, I think back in 2014, as a way to help the Fed manage its interest rate. So the interest rate that you hear about, the overnight Fed's fund rate, it's really irrelevant. The Fed needs many other tools. So once you got to zero bound, and once you got to needing to do quantitative easing and all that sort of stuff, the normal interest rates ceased to become all that useful. So the Fed had to create all these other tools to try and help it manage its interest rate. So it created the reverse repo account, and that exploded in growth in 2021 because it was a way for the Fed to try to take liquidity out of the market. As I mentioned, it doubled its balance sheet. It created a huge boom into 2021 as there was all this money chasing cryptos and tech stocks, and that's where you got that big bubble from. But then they increased the interest rate on the reverse repo balance, and that sucked in a lot of liquidity. So if we look at the various aspects of this equation, you've got and I've done this to show the annual change in dollar terms. So this is Reserve Bank credit, and as you can see, quantitative tightening has kicked in, and over the past 12 months, the Fed's balance sheet has shrunk by about 400 billion. And this next chart shows the reverse repo change over the past 12 months. So as you can see here, it's nearly a 400 billion reduction over 4 months. Now that actually means it's a net liquidity injection into the system. So it's practically offset any contraction that the Fed has done through QT. And then if we look at the general treasury account, that is down just over 400 billion as well. And again, the same as the reverse repo, any reduction in the treasury general account is an injection of liquidity into the system. So just on those measures there over the past 12 months, there's actually been a net injection of liquidity into the system. So if we go back to this equation, even though the Fed has been raising rates, even though the Fed has been doing QT, the fact that the general treasury account has fallen and the fact that the reverse repo account has fallen, that means there's liquidity being going into the system that has more than offset the attempts of the Fed to reduce rates, which is why the S&P has held up. And if you look at going back to those earlier charts I showed right up the start, we're at extreme greed levels, whereas 1 year ago we're at extreme fear levels. So the combination of good liquidity conditions and the shift in sentiment from fear to greed has been behind this rally in the stock market. And that has nothing to do yet with this sharp contraction in bank credit. And that's where the lagged effect of interest rate rises really do have an effect. So at the moment, the market's focusing on liquidity. The market is supported by great enthusiasm and extreme greed sentiments and just in general positive sentiment. But if you look at this chart, it's showing that bank credit growth is contracting sharply, and that takes its time to work its way through the economy. And the stock market will eventually reflect economic conditions. It's just that they're in the future. And at the moment, the market's celebrating liquidity and just feeling good in general. So if we want to bring it back to what's not priced in, and if you look at the S&P 500 and its earnings projections, we spoke about it a few weeks ago, the S&P 500 forward earnings, are assuming that earnings bottom in this quarter, and then they're going to start rising again. Whereas those forward indicators and that quote from Dave and Roseberg suggests that the real pain happens after interest rates stop, and then we wait for the lagged impact of previous rises to flow through. And the market's just not pricing that in. And I think that's the biggest concern moving forward over the next few months.
And do you think it's not pricing it in purely because of the net liquidity sloshing around the market?
That helps. That certainly helps. And
that helps. Yeah.
I think just in general, when sentiment is this really strange thing that is really difficult to rationalize. And if a good way to explain it is when if you think about the market being on PE ratios, and when there's fear and when there's concern about the future, let's say the market puts stocks on a PE ratio of 10. In normal times, it might be 15, but in fear times, it's 10, which means that the market falls considerably, even though earnings might not. The market just decides to put a lower multiple on those earnings. And then in times of great optimism, the market might say, well, I'll price these earnings at 20 times. And then you get a big rise from that. So there's no underlying change in the fundamentals. It's just that pessimism or optimism just decides to price assets differently. And at the moment, the forward multiple on the S&P 500 is about 19 times, which if interest rates are 1 or 2%, you could understand that. But when you're getting over 5% on 3-month bonds in the US, then you wonder if that's an accurate pricing or whether that is just based on unfounded optimism. So that's really how I rationalize it. Liquidity plus optimism equals high share prices. We know the Fed's going to continue to do QT, so that the balance sheet will continue shrinking very slowly over time. Whether the Treasury General account, we've talked about that as well, that will be rebuilt back up to probably levels of around 500 billion. So over time, that will take liquidity out of the market. So that leaves the reverse repo account to do the heavy lifting. And recently that we've seen a lot of money come out of that account, and whether it's gone into money market funds or whether it's gone back into the stock market, who knows, but it's created liquidity in the system because it's not sitting at the Fed. So whether those conditions persist or whether there's going to be a change, I don't know. But I do know that a lot of forward-looking indicators for the economic growth situation in the US are turning down and are looking dicey. And the last piece of the puzzle missing on that front is really employment. And the rallying cry of the bulls has been, well, employment is still hanging in there. People have still got jobs. People have still got incomes, and therefore they're going to spend, which, it's a fair enough point. I completely get that. But the other, I guess, response to that would be that employment is a lagging indicator in the same way that inflation is, and you will only get increases in unemployment once you're starting to see the slowdown. Or those increases will only come through once the slowdown has already kicked in, and it'll be too late to really do too much about it. So, so I think that's what we're looking at. We're going to see a slowdown in the US economy, and my view is whether the market wants to acknowledge that at some point. All I'm saying is that it's not priced in at the moment.
Yeah, so it's pricing in a lot of greed, but not enough reality. But I think also in the employment aspect of it, there was a very interesting paragraph from I mentioned her already, the Reserve Bank's Deputy Governor Michelle Bullock, and she said that that on her assessment, or the RBA's assessment, for the first time in decades, companies' demand for labor exceeds the amount of labor that people are willing and able to supply. And so, in other words, employment is above what we would consider to be consistent with our inflation target. So, and she said that I think right now employment is about 3.5, 3.7%. She expects the unemployment rate to rise to 4.5% by late 2024.
So that's a decent rise.
And she also that's a decent.
Which means that probably comes with something very looks like a recession.
Yeah, exactly. And when people are losing their jobs, or they think that they may lose their jobs, or they see their friends losing their jobs, that's going to have an effect on how they deal with their savings.
Yeah, and it affects sentiment.
They're going to want to keep that money.
It affects all those sorts of things. So, but not to get overly bearish. I just think that the market is probably yet to price that situation in. But certainly, when that gets closer, I think that'd be. Look, we talked about the property trust last week, right? I think there's lots of sectors that are priced pretty attractively at the moment. There is probably earnings downgrades to come, so you do need to be careful about that. But in many cases, you are seeing lots of lots of really attractive opportunities. It's just that some of the headline stocks, some of the larger stocks are really probably obscuring some of the value that's out there. And a good example, which we spoke about a couple of weeks ago, was Commonwealth trading at over 2 times book when a competitor of its that has the same profitability, JP Morgan, was trading at 1.3 times book. So there's a big difference there between those valuations. So from a headline perspective, indices, a lot of the Aussie stocks the Aussie market looks pretty stretched and ripe for a fall, but there are plenty of stocks that I think are really going to be really good buying if we do get continued sell-off in the months ahead.
Yeah, exactly. It's not, it doesn't pay to be overly bearish about the stock market as a whole, because as you always say, it's not a stock market, it's a market of stocks. And I think just yesterday I told you that two stocks reached their 52-week highs. Well, not just two, but two of the more interesting ones was Brickworks. I thought that was quite interesting given its heavy involvement in bricks and building development. And the other one, also quite interestingly, was a luxury retail stock called Satire. I think that's how you pronounce it. And it's up, I think, 90% year to date. It finished 9% higher yesterday when the market was, as a whole, was clobbered. And I think over the past 12 months, it's up 500%. So it's quite an interesting stock. But to be fair, though, it has rebounded from very low base. I think it reached a peak, I think, around 2021, and then it fell about 90% into June 2022. So I think bargain hunters came in, and
but you make a good point, and
but again,
is that there are always opportunities out there. Like there's a couple of stocks in the portfolio that I manage for subscribers that have done really well in the last just couple of weeks. So I mean, we've been in IAG, the insurer, for 12 months now, and that's shot up really, really strongly, and we're up over probably around 30% on, or maybe 25% on that position. James Hardie's done really well for us since we bought in at the start of the year. Horizon Holdings has had a really strong couple of weeks. It's just shot up really strongly. So when we talk about these things, we're sort of talking about it on a market perspective. The market looks overvalued, but certainly under the surface, I'm seeing lots of opportunities. The question for me is, are you buying something where the earnings have been rebased and the earnings are pricing in some kind of recessionary outcome? For example, James Hardie, we bought into that after it had its third profit downgrade for the year. And when a company has 3 profit downgrades, you think, okay, that's close to resetting where it probably is possible to grow from again. So these are the sorts of things that I look for my subscribers. And when we talk about these things on this podcast, we talk in general terms, and we don't talk about specific stocks so much. So it's not all doom and gloom, but we are sort of giving an overview, and that overview is that until we see blood in the streets, until we see headlines and magazine indicators that tell us that now's the time to get out of the market, I think we still need to be cautious about this lagged impact of monetary policy not being priced into the market, and therefore that should feed through into how you think about portfolio construction, whether you're holding some money in cash. Like I've been buying some bond funds recently just because the bond yield is quite decent, and I think if we do go into a slowdown, bonds should do quite well. So being quite defensive. I think a sector that we could probably look at in the weeks ahead is gold stocks. I've seen gold stocks start to come under pressure over the past couple of weeks. I think it might be worth doing a deep dive into that. So if any listeners, if you're keen on us doing something on the gold sector or anything else, feel free to leave a comment, and we'll try and get to it in the weeks ahead.
Great. Well, with that said, I think that's a perfect time to sign off. And yeah, as Greg said, if you want us to cover any topics, especially like gold, leave a comment. But also make sure to like and subscribe, and always ask yourselves what's not priced in.
Thanks, Kiryll. Good stuff, mate. See you, everyone.
See ya. Thanks for joining What's Not Priced In, the your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.